Hello Sector Watchers, welcome to the show. This is the 169th episode of Sector Spotlight for Tuesday the 28th of March, and I'm recording this on Monday the 27th after the close of the US markets. My name is Julius the Kempenaer, and as usual I am presenting to you from Amsterdam in the Netherlands. It is the last Tuesday of the month, which means that we will look at seasonal patterns in combination with current sector rotation. And we're going to try and see if we can find any meaningful alignments that give us trading opportunities. Of course, we will take a look at the broader state of sector rotation as well, and I'm throwing in an overview of the interaction of sectors on a relative rotation graph in combination with their weights in the S&P 500. Ladies and gentlemen, this is Sector Spotlight. Let's take a look at the historical seasonality for the month of April, which is about to begin. And if we start with the seasonality for SPY itself, for the market, for the S&P 500, then we can see that April is actually one of the strongest, together with November, if not the strongest month for the stock market. Over the last 20 years, 80% of the time, SPY closed higher than it opened. So that is a pretty significant number. That is the good news, I would say. The bad news is that there are not very outspoken sectors either underperforming or outperforming the S&P 500. So that means that in general, if the market follows that pattern, it's a very broad-based pattern, and you can see that in the percentages for each and every sector, which represents the outperformance, the percentage of months that this sector actually is outperforming the S&P 500. So the S&P itself, SPY, is the outright seasonality, and all the other figures here are relative to the S&P 500. And what you can see that there are actually only two sectors which I consider to be worth looking at, which is communication services at 67% and consumer discretionary at 65%. And even that 65 and 67% is not all that great. I mean, if you've got 70 or higher, that is what you really want to look for, or 30 and lower. So the 40, 45, 50, even 60 is not, I mean, you really want to have a strong number in terms of percentage outperformance to make it worth your while. Or at least the higher the number, the more conviction you have in that view. So for now, for April, it's communication services at 67%, and consumer discretionary at 65%. I will be looking at the charts for these individual sectors in a minute. Now, if we go to the lower part of this sheet, then we see the performance numbers. And again, the performance number for the S&P is the outright performance, the average performance in that month for SPY. And all the other numbers here are relative to SPY. So communication services, historically, on average, in the month of April, outperforms SPY with 0.5%. So, 1 and 1 is 2. So ideally, in line with this sheet, communication services should go up 2.9% this month. Obviously, that's very theoretical, but that's how you should read it. And consumer discretionary, 0.9. So we're looking, again, historically, on average, based on seasonality, at 3.3% gain for consumer discretionary, which would mean 0.9% outperformance of the S&P 500. Now what you'll also see is that especially in this bar here for the month of April with those outperformance numbers, that especially the energy sector at 1.8% outperformance with only 55% of the time outperforming, still something that you might want to look at. And then here we have real estate on average outperforming 1.7%. But it's the flip of a coin, because 50% of the time it's outperforming, which means that 50% of the time it's underperforming. But when it's outperforming, it outperforms 1.7%. So that is really strong. So we're going to take a look at the individual charts for SPY, for communication services, and consumer discretionary. And also a quick glance at energy and real estate and see if we can align that together with the rotation as it's currently happening on the RRGs. And here we are with the RRG for the sectors, and on the right hand side I have the individual charts, and we start with the chart of SPY, which is obviously the center of this chart here on the left. Now, SPY is historically going into a strong month. If we just look at the chart here, then that is certainly a possibility, because we still have a month to go. We still have to close the month of March and then start the month of April. And we are currently going through a small corrective move. And the big debate right now, I think, and let me try to word that correctly, is that or the doubt maybe is that, are we still in a downtrend? And is this a new leg lower, moving lower in the existing downtrend? Or did we break the downtrend at the start of 2023 when we took out that falling trend line? And are we now in our first corrective move after breaking that downtrend? And are we looking for a new low to be put into place and move higher and start, continuing this series of higher highs and higher lows as it seems to be emerging out of that October low? At the moment, I am in the camp of the latter. I think that we have broken the downtrend, that we are currently in a corrective move within that new uptrend that is developing, that is emerging. We do need a lot more confirmation, that's for sure. But also for arguments that I've given you in past shows, and we may have a look at that at another stage in the show, where we are still seeing rotation out of defensive sectors into more offensive sectors. Also the growth value comparison, all of these pieces of the puzzle make me adapt to the scenario that we have ended this downtrend and that we're looking to build a new uptrend. And again, we do need more confirmation, but I think there are enough arguments to stick with the fact that we're in a new uptrend. So with that scenario in the back of my mind, and the knowledge that historically seasonality for SPY, for the S&P 500, is very strong, I'm actually watching for a break of this short-term falling trend line here. And if I have to attach a number to it, then I would say that is 406, and certainly here that 416 level, eventually 426, but that's further out. If we subsequently take out previous highs, that is going to give more and more confidence for a potential further rise and for the S&P 500 to respect its historical seasonal pattern of a strong market going into April. Now, as I told you, as I showed you on the spreadsheet, we've got communication services and consumer discretionary as potentially the strongest outperformers for the S&P 500 in terms of sectors. If we start with communication services, that is inside the leading quadrant. It's been there for a while already. You see that it's losing a bit of relative momentum. It's going lower on the JDKR's momentum scale, but it's still the highest reading sector on the RS ratio scale, and that's a good thing. So if we bring it to the chart here, then you can see why that is. You can see how that, especially in terms of relative strength, we have reversed that downtrend, and that also happened on the price chart. So there are two arguments here: a strong price chart, and you see that how that former resistance, now support, was respected very recently. And if I just put on your fantasizing hat here and look, I mean, it's not, this is more art than science, but if you look, we're at the end of a downtrend, that's for sure. How about we say this is the left shoulder, we got a nice double bottom pattern as the head, and we're now we've just put in a new right shoulder. And we're on our way to the neckline of that reverse head and shoulders pattern, and if we break higher, we got a super strong signal for communication services. I wouldn't be surprised if that happens, because we're ending that massive downtrend. It's about time that the sector is going to pick up again. In terms of relative strength, it's already doing that, and you can see that after that initial rally, relative momentum is now rolling over a bit, but the RS ratio is at a very high level, which makes it very well possible for XLC to rotate through weakening and then back up to leading again. So there's all to win for here, and XLC could certainly live up to its historical seasonal pattern of outperforming the S&P 500 with a pretty significant number in the month of April. So keep an eye on communication services. Now the second one is consumer discretionary. Kind of different, but still. So here is the tail for consumer discretionary on the RRG. It's still inside improving, and it's also losing a little bit of relative momentum. Where it's not so much of a problem for XLC, I'm a little bit more worried about XLY, because you really want to see a tail from improving, moving into leading at a positive RRG heading. That's not the case with XLY anymore. It's not at a negative heading, but it's just over 90 degrees, which is like still moving to the right, but not super strong. It's not backed up by rising momentum anymore. I think that the price chart and the relative kind of reflect that image. The price chart has ended its downtrend probably already mid-2022, although it wasn't very apparent at the time, but the most recent decline dip at the end of the year kind of was very briefly, and right now around 130 there is very clear support visible for XLY. That's the same thing, there is a pretty significant resistance visible in that there's a pretty broad range, I'd say. It's let me put the toggle on here. So it's about 150, let's rough it off at 150, 155, that range where we just put in that new high. So right now we're looking if we can form a new higher low and attack that new area of resistance. That is certainly something that is needed to actually live up to the expectation of outperformance going into April. And the same goes for the relative strength line, because here the reversal is definitely not as clear as it is for XLC. We do need to take out this most recent high here, so that's the February high in terms of relative strength, to actually get that upside potential for relative strength and for outperformance of the S&P 500 for the consumer discretionary sector. So out of communication services and consumer discretionary, I think my preference for the time being would be with communication services over XLY as the sector to outperform the S&P going into the month of April. If we quickly look at the energy and the real estate sectors, because they weren't really, in terms of seasonal patterns, very shocking. They were kind of in the middle. But the average performance is quite strong. And if I look at energy here, then this is not very encouraging. I think that the energy sector has just kind of completed a double top pattern here. It broke below that rising trend line, and it's now trying to get back up, but it's going to be very difficult because right after that former rising support line, there is the low of that double top formation. So in the area between 80 and 82, roughly, there is a ton of resistance for the energy sector. And if you look at the relative strength line, that is not good news either. You can see how that has rolled over, and week before last, we have broken below horizontal support with lower highs in place, and that is sending both RRG lines lower. And if I put that here on the RRG, highlight that tail, then you can see what's happening here. So with this combination of that tail moving rapidly into the lagging quadrant, the price chart that has put in a completed double top and is challenging a break of its former support line and relative strength rolling over, I don't think energy will be a very strong sector in the month of April. The seasonal strength or the average strength may slow down the decline, but I don't think it's buy-worthy. I don't think it's a sector that you would really go in all in. You don't want the bet to farm on a price structure like this. If we go to real estate, then kind of similar structure. You can see real estate here also. That's even worse than XLE because it is rotating through improving, and it didn't even make it to the leading quadrant, rolled over, and is now hitting the lagging quadrant. So real estate is actually a really weak sector at the moment, although the seasonal pattern doesn't seem to indicate that, nor does the average percentage gain. But if you look at the price chart, this is really bad. This structure of lower highs and lower lows is definitely still intact. That has not been broken. Hiccup, this recovery within the downtrend is broken. We broke below the previous low, and we're kind of on the way to challenge that support area between 34 and what's this? That's 33 and a half. And you don't even want to look at relative strength here because that has just basically confirmed a strong negative relative trend, and that's sending both RRG lines lower. So out of these four sectors, XLC is definitely the strongest one. XLY is okay-ish, but it needs a lot of work before it can actually start to live up to its seasonal expectations. Energy and real estate are showing flat numbers in the 40–50% range in terms of outperformance. They're showing very strong numbers of average performance in the month of April in general. However, given the current structure, the tails on the RRG and the price structure and the relative charts, I don't think that's going to happen for neither the energy sector nor the real estate sector in the month of April. Let's move on to the current state of sector rotation for the other, or for a few other sectors in the US universe. If you look at the RRG in general, I think that it's very clear that there is a high concentration of tails inside the lagging quadrant. And only two, as we've seen, communication services and tech inside leading. One in improving, it's a big sector, it's consumer discretionary, and we've got two inside weakening. Consumer discretionary in improving has already lost a little bit of relative momentum, and industrials and materials inside weakening are kind of on a weak heading. They're moving towards the lagging quadrant. XLB a little bit more than XLY, or XLI, sorry about that. So what this image tells us at first sight is that the market is narrow based. It's pretty much only technology and communication services that are doing really well at the moment. So they're holding up the S&P 500 together with consumer discretionary. All the others are forming a drag on the S&P 500. And I've created a chart or a copy of that RRG with the weights of these sectors included on it. And it's interesting to see how these weights are related to each other. So technology is about 26% at the moment, and communication services is about 8%. So that's together 34% of the market capitalization of the S&P 500. All these together, combined with the vectors to the center, end up in 0. So if we take the distance from the center to the endpoint of the tail, and we multiply that by the weight, and then add everything up, then it becomes 0 or very close to 0. And what you can see here is that 34% of the market cap is inside leading, which is not enough to offset all of this at first sight, because we've got 13 for financials, 14 for healthcare, which is already 27, and then add consumer staples, and you're already at 34. So then we have energy, that's 38.5. We've got utilities, that's 41.5, and we've got real estate, that's 44. So at first sight, you would say, hey, it's biased to the downside. However, all of these vectors are shorter. So technology and communication services together are stronger than all these tails with the weights that is in weakening. And if we do the same exercise on the opposite diagonal, we've got 10% in consumer discretionary, and this is about 11 in industrials and materials. So this is how you sort of have that weight and that equilibrium inside sector rotation that makes it so interesting to track. Now, there is a bit of downside here because it makes it a risky situation, because obviously tech and communication services together is everything that is holding the market up. So we do need improvement somewhere on this RRG to join communication services and technology inside the leading quadrant to give that market a broader base, so to say. And probably consumer discretionary is the best candidate at the moment, although it's losing a little bit of momentum, it's still heading in the right direction. Consumer staples seems to be picking up, and so does utilities, but they're far away to the left. Energy is not going to help us. And financials, that is a bit of a bummer, because that is an important sector at 13%, and it's not looking very strong. If you look at the individual charts for materials and industrials, I'm not sure how that's going to play out, because they don't look too strong either. Let's take a look at the individual charts of these sectors quickly. So technology, there's no doubt about it that is a very strong sector. Look at how it broke that downtrend and how it's clearly working its way higher in a new series of higher highs and higher lows. And despite market has just closed in the US and tech today was the weakest sector, but it's still holding up above that previous high. And it could even dip a little bit into this area here, but it will still hold up that series of higher highs and higher lows. And that is depicted by the strong relative strength, which took out that horizontal resistance level. So there's no doubt about technology. Comms we already saw in the seasonality part. If we look at financials, then that's an important sector, as you know. And we can see that it is resting at support. Relative strength for the time being doesn't look very good. If financials can hold up here, that's definitely going to be a good sign for the market as a whole. We do need financials to at least not go down, and preferably start moving up a little bit to support and give the S&P 500 a bit of a broader base, so to say. If we look at materials, you can see that it's inside that trading range, but it's very unclear. You can see even a small trading range and a very broad trading range. And the same goes for relative strength. So relative strength here doesn't look very good. but there is quite a bit of support here. So if I want to look at it from a positive point of view, then it is possible that materials will turn back up and start moving. But again, it's not too big of a sector, and there is definitely a risk that it moves to the lower part of that lower boundary of that range, and that'll push that tail into lagging. If we go to industrials, then we see a bit of a similar image, a small trading range. Relative strength here has clearly broken below its previous low, so that's signaling weakness ahead in terms of relative strength. If that dips below that support area, then that relative strength is definitely going to go down. So all in all, the image for the S&P 500, as I said in the start, is still pretty good. We're going into a very strong month of April, but the base at the moment is very narrow, and we do need support from other sectors, preferably financials, although it's probably going to be difficult to get a broader base for a solid footing for the S&P to rise any further. And that is the end of Sector Spotlight for this week. Ladies and gentlemen, I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. You can catch the replays and watch previous shows on StockCharts YouTube channel or any of the on-demand channels. If you would like to engage in a discussion, you can do that in the comments under every video on YouTube or the discuss section under every blog article. Alternatively, find @RRG Research on Twitter, Facebook or LinkedIn, or simply shoot me an email. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.